Hello everyone, this is Crypto BitLaw, and today we wanted to give you guys a news update as to what's going on in the blockchain related legal and regulatory landscape. And today we wanted to cover these topics. As you can see right here, crypto exchanges are set to face tougher regulatory scrutiny from the SEC chair, Gary Gensler. The SEC also recently rejected a Bitcoin ETF plan that was produced by Anthony Scaramucci and his firm Skybridge Capital. The U.S. House held a hearing regarding Bitcoin mining and questions power usage related to Bitcoin mining. Crypto.com, the exchange, recently confirmed that it lost nearly $34 million due to a hack. British government recently legislated to protect consumers from misleading crypto ads, and European regulators are calling for a ban on proof-of-work mining used by Bitcoin and Ethereum. So we're going to break down all of these different topics and do a little deeper dive into each one. As always, all of the content cited here is going to be linked down below in the description. And if you like this content, please hit the like button, subscribe to our channel, and follow us on Twitter. Our handle is @CryptoBitLaw. And with that said, let's check out the news. So first up is this Yahoo Finance article, which reported that SEC's Gary Gensler wants crypto exchange regulation in 2022 and warns on stablecoins. And this is a follow-up to our video about the SEC and their approach to a Bitcoin ETF, where we touched on a lot of these issues, pretty much calling what they were actually going for at the SEC, and it's all pretty much shaping out exactly like we said it would. As we dive deeper into this article, we can see the Securities and Exchange Commission Chairman Gary Gensler said on Wednesday he hopes that this will be the year that the agency regulates cryptocurrency exchanges. The SEC chief likened the asset class, digital coins that are pegged to a commodity or fiat currency, to poker chips. He's talking about stablecoins. Gensler reiterated that his views that some stablecoins already may be securities that must be registered with the SEC, and that the majority of cryptocurrencies are securities. To the extent that folks are operating outside the regulatory perimeter but are supposed to be inside, we will bring enforcement actions, said Gensler. And this article further notes that platforms are trying to contend that stablecoins are stable and backed just like money market funds, raising important public policy concepts for regulators, said Gensler. Stablecoins were invented by trading platforms, and legal owners of stablecoins are the trading platforms. And the trading platforms are saying, here's a return on a token. So it's hard to unscramble that. And, this kind of touches on some of the things that we saw with Circle and the recent hearing before Congress, where Coinbase and Circle, as two intertwined entities, are actually trying to not only get clarity on the regulation, but work within it in order to pretty much become a de facto bank and effectively issue these stable coins. So it'll be interesting to see how this all shapes up, but I guess the big takeaway here is that regulation is coming. And next on the docket, we could see Bloomberg reports that SEC rejects Bitcoin ETF plan from Anthony Scaramucci's Skybridge Capital. Ultimately, the proposal fell short of the standards that the SEC uses to prevent fraud and manipulation, and the agency has yet to approve a U.S. spot Bitcoin ETF. And just like the last segment, this is a furtherance of a lot of the things that we discussed and ultimately called in our Bitcoin spot ETF video. So if you haven't checked that out, please go check out that video. There's a lot of really good information, and it's just, the more time passes, the more the things that we called in that video end up coming to light. So digging deeper down, we can see it reports the First Trust Skybridge Bitcoin ETF Trust proposal fell short of the standards to prevent fraudulent and manipulative practices and to protect investors, the agency said in a filing on Thursday. The regulator used similar arguments to deny proposals from Valkyrie Investments and Cryptoin in December. The SEC has yet to approve a spot Bitcoin ETF, though it gave the green light to the futures-backed Bitcoin ETF in October. And here's a funny little tweet we could see. This is from James Siffart, And it says, and now Fidelity's on the chopping block. Their denial letter will come next week on or before Thursday, 1/27 of 22. Still most interested in the final decision letter on Ethereum's Bitcoin ETF futures ETF filing, which will come by 4/8 of 2022. And it's that classic Grim Reaper meme where we can see, just a murderer's row of slaughtered hopes and dreams for all of these different Bitcoin ETFs, with the Grim Reaper knocking on the next door. We can see VanEck, Wisdom Tree, Cryption, Valkyrie, Skybridge, and then of course, Fidelity is going to be next. So all of these different groups ultimately applied and were denied for their ETF, and there's pretty much no doubt that this trend is going to continue with Fidelity. Moving on to our next story, we can see that Bloomberg reports that Bitcoin mining's hearing in the U.S. House questions power usage. Hearing comes as mining's power use is increasingly questioned, and this House representative member called out two mines as deeply concerning. They say a U.S. House subcommittee hearing on, quote, cleaning up cryptocurrency and the energy usage of blockchains kicked off Thursday, with one representative calling the energy consumption of some Bitcoin mines, quote, deeply concerning. Representative Diana DeGette, a Colorado Democrat, said in her opening statement Thursday that the blockchain technology has promising applications, but mining's energy efficiency and carbon emissions need to be at the forefront of any discussion about crypto. Lawmakers specifically raised concerns about repurposing of old coal plants in New York and Pennsylvania to support mining operations. Quote, we cannot bring retired fossil fuel plants back online or delay the retirement of some of our oldest and least efficient plants in support of energy-intensive crypto mining, said Representative Frank Pallone, the Democrat who heads the Energy and Commerce Committee. It's interesting to note that the hearing, it was held by the House Committee on Energy and Commerce, but one of the witnesses that they had was Bitfury's chief executive officer, Brian Brooks, who's really a really smart, knowledgeable, and eloquent representative for the crypto industry. He was at the House hearing on crypto in regards to crypto regulation with Sam Bankman-Fried and a few other crypto executives. Here's the Bitfury website, and it profiles Brian Brooks as the CEO. You can learn more about him here. It's interesting what Bitfury does. They specialize in blockchain analysis software, pretty much trying to eke out suspect and potentially fraudulent transactions on the blockchain or manipulative market participation. So I guess kind of their software uses AI and pattern recognition to try to eke out potential manipulation on chain by market participants. But what they also do is they produce some of this Bitcoin mining hardware, as we can see here. Here's some of their hardware they produce. So I think it's only natural that they would want to put Brian Brooks front and center during a House committee on the concerns related to Bitcoin mining in order to, I guess, hedge their bets and make sure that their positions are heard and that a lot of these regulators are properly educated. On another point, touching back on that issue of some of these miners using old coal plants or natural gas plants to power their mining rigs, it's interesting to note that certain miners, I guess for example Green Ridge, they'll actually purchase carbon offsets in order to offset the emissions from their rigs. So you have this situation where certain regulators create this whole carbon offset system, and then it's actually being utilized by miners that are buying these offsets, but it's not enough for these regulators and lawmakers that just kind of want to pander to their bases and jump on whatever moral high ground that they have, spreading FUD about how Bitcoin mining is destroying the environment. But when in reality, they're actually using the system that they set up in order to play within it. But I guess that's not good enough. So I guess just an interesting point. You can see this article is going to be linked down below in the description as well. Moving on to our next story, we can see that Decrypt reports that Crypto.com confirms the exchange lost nearly $34 million due to hackers. And what's interesting about this story, it was kind of an evolution of more and more truths coming out. At first, they didn't admit the whole truth. Oh, there really wasn't a hack. And then it became, oh, Crypto.com admitted there was a hack, but it was only a certain amount and it only affected a certain amount of users. And then it finally evolved to the point where they actually admitted it was 34 million and it affected more users than they initially reported. So digging down deeper into this article, we could see they say Crypto.com, the industry's fourth largest cryptocurrency exchange, finally admitted it lost user funds due to a recent security breach. According to a blog post published on Thursday, the incident affected a total of 483 users, resulting in unauthorized withdrawals totaling 4,836 Ethereum, 443 Bitcoin, and approximately $66,200 in other cryptocurrencies, or roughly 33.84 million in current prices. The Singapore-based Crypto.com announced it was pausing withdrawals after a small number of users experienced unauthorized activity in their account on Monday. And they urged users to reset their 2FA, their two-factor authentication. So a security company, PeckShield, later revealed that the incident resulted in Crypto.com losing at least 4,600 ETH, around $15 million in user funds, telling Decrypt that the scale of the damage was definitely worse. So we could see it's this kind of evolution of actually admitting to what happened over time, trying to do damage control, but then when you don't actually have control over it, the truth's going to come out eventually. So according to PeckShield, half the stolen funds were sent to Tornado Cash, a crypto mixing service that enables users to obfuscate their transactions. So unlike the Colonial Pipeline hackers who just operated and transacted directly in Bitcoin with that hack, these hackers, smart. They used a privacy-based crypto, Tornado Cash. I know other alternatives are Zcash or Monero. These hackers actually kind of knew what they were doing and were smart enough to anonymize their stolen funds by using Tornado Cash. It continues, despite the litany of evidence, Crypto.com initially refused to acknowledge the hack, with the company's CEO, Chris Marszalek, claiming that no customer funds were lost. So, as we could see, as we stated earlier, it was this gradual evolution of them finally having to own up and admit to the truth of what really happened. He added that same day that all the accounts were affected, they were reimbursed, so there was no loss of customer funds. And then it continues on that Crypto.com, as a result, they're going to announce this worldwide account protection program that's designed to protect user funds in cases where third party gains unauthorized access to the account to withdraw the funds without permission. And so it pretty much, it's not insurance per se. It acts like insurance. I guess it's one of those things, if they were to call it insurance, then they'd have to get licensure and regulation through, insurance commissioners throughout the various states and those governing bodies. But pretty much essentially, they're announcing that they're going to insure these funds up to $250,000, and they put some requirements on the user, like having to file a police report and submit to a forensic investigation. So I think that was interesting. Let me know what you think about this in the comments below. Next up, Decrypt also reported that the British government legislates to protect consumers from misleading crypto ads. So this is following a worldwide trend of different sovereigns cracking down on fraudulent or misleading crypto ads in order to protect wary consumers. So they say the British government is introducing new legislation to protect consumers from misleading cryptocurrency advertisements, according to a recent announcement on the government on a government website. In part, it says that crypto ads will need approval by the Financial Conduct Authority, the FCA, or the Prudential Regulation Authority, the PRA, or a firm licensed by either of those branches of the government. Further states that in other countries, the responses have been tougher. This week, Singapore's financial services regulator, the Monetary Authority of Singapore, told crypto companies to stop advertising to the general public. And also, Spain's National Securities Market Commission said it would impose fines of up to $300,000 if crypto companies, advertisers, and influencers fail to comply with new rules aimed at providing Spanish consumers with greater protection, transparency, and accountability. So, as we said earlier, this is part of a growing trend of nations and governments trying to crack down on predatory advertising for cryptos to the public. This isn't all that different than various forms of regulation that apply to certain professions. I know that in the legal world, my jurisdiction in particular, if you were to advertise on TV or on a billboard or in a phone book or something like that, there is actually a board set up through the ethics board that regulates legal ethics in the state. So you would actually have to submit your advertisement to this legal ethics board that would then review it and then approve it or deny it. So it's this whole multi-step process that you have to go through in order to actually advertise. And I guess that in itself is an evolution, because it used to be, I think back in the 70s or the 80s, lawyers weren't even allowed to advertise. But then, one lawyer ended up suing the Supreme Court and said that that was a violation of his constitutional rights. He had First Amendment protection, so on and so forth. And they eventually compromised and said, hey, yeah, lawyers, you can advertise, but if you're going to do it, it has to meet certain criteria and you have to get your advertisement approved. Now, it's interesting. There is also a safe harbor where you could set up solicitations on a website or on social media and not have to succumb to those same regulatory requirements that you would otherwise have to meet with the board approval if you were to advertise on television or on a billboard or something like that. So that's an interesting little anecdote. I can foresee crypto regulation falling in line with regulation for advertising in these same sorts of professional areas, whether it be medical or legal or just other financial services in general. And finally, turning to our last story, we can see here that Decrypt also reports that EU, European Union, regulator calls for a ban on proof-of-work mining used by Bitcoin and Ethereum. They say Eric Theeden, the vice chair of the European Securities and Markets Authority, has called for a ban on proof-of-work crypto mining based on the industry's high energy demands, per the Financial Times. He stated that the solution is to ban proof of work. Proof of stake has a significantly lower energy profile. However, Theeden also emphasized that he was not advocating for a general ban on the crypto industry. He stated, we need to have a discussion about shifting the industry to more efficient technology. And so, this falls in line with a lot of the FUD that we've seen recently about Bitcoin mining being wasteful and just consuming too many resources and so on and so forth. But, therein the fact that proof of work is so energy intensive, I think that that is in part what gives value to proof of work networks, in particular Bitcoin, when it takes so much energy that is not so readily available in order to shore up and solidify and keep the network active. That in itself has a value proposition. So, I agree that proof of stake would be beneficial for certain things, in particular smart contract platforms. It has its place, but when you really consider what Bitcoin is and the value proposition, the fact that it's so scarce and the fact that the network is so powerful, the actual computational power behind the network and all of the energy that it takes in order to shore up that network, that in itself has value. So I don't think proof of work, that's definitely not going anywhere for Bitcoin anytime soon. As we all know, Ethereum's trying to move over to proof of stake with ETH 2.0. If that's going to happen, when that's going to happen, no one really knows. I think it's still going to be a long time, but I think they raised some interesting points. A lot of this is kind of fuddy, but as we've seen, one of the great compromises in this space is the use of renewable energy, like they're doing in El Salvador with the natural, I think it's a geyser-based energy harvesting and other green renewable methods of utilizing that energy and using that to mine Bitcoin. Or in places where there is a surplus of energy, using that surplus energy to mine Bitcoin, because in some instances it would otherwise be wasted. So all in all, I think that this series of headlines was informative. I hope you guys enjoyed it and learned something. If you like the content, as always, please drop us a like. Please also subscribe to our channel. We'd really appreciate that. Follow us on Twitter. Our handle is @CryptoBitLaw. And with that said, I'll see you guys next time. Thanks for watching.